It's the Downbeach Buzz podcast for April 10, 2026 with Sherry Lilienfeld. It's all powered by EXP. Go to realtysherry.com. Commercial, residential. Maybe you need a buyer's agent. Reach out to Sherry Lilienfeld at EXP. How about that? And then, of course, Paul Scollage from rate.com. He's the senior VP of lending at rate.com. Reach out to Paul Scollage. You're not going to lose. Go to rate.com with Paul. These are some questions that have come in over the past couple of days, Paul. People know you to be somebody knowledgeable, even with uncomfortable topics when it comes to financing for new homes, maybe secondary homes, maybe you're an investor. So that 6% interest rate, that mortgage number we always hear about, that 6% number teetering back and forth, left and right over that line, it's psychological. How does that affect your business day to day at rate.com?
It's interesting that, that 6% number is like the barometer that everyone shoots and hits off of. The validity that we've seen right now in the market has been probably the highest in a very long time. I mean, 4 weeks ago, I was sitting somewhere in like the mid 5%, 5.5, 5 5/8, 5 3/4. Jump start to where we are today, 3.5, 4 weeks later, and we're in the mid to low sixes. And really, what people look at is, and I tell people all the time, I said, don't get so much caught up in the interest rate. Yes, the interest rate has a major impact on your monthly number, but it's short term, right? You're going to get out of this loan within the next 12 to 18 months if you purchase here in the next 1 or 2 months. The Fed is projected to set up. We have a new chairman coming in play in the beginning of May, and rates will absolutely go down. So, is it marry the house, date to rate, that whole philosophy? It's something that we want to look at. If you can get in on the property that you want today, please don't get caught up so much on the rate. It's a short-term rate. You will get out of that rate, but that 6%, everyone's so stuck on 6%, and we will definitely see rates get below that. There are other alternative things you can look at. Adjustable rate mortgages, which will absolutely get your rate somewhere into the fives. That will, drive your monthly payment down with the intention of looking to refinance at some point, in the future, whether it's the end of 27 or early 28.
30-year fixed. We have great credit. What can we do, Paul?
Yeah, I mean, so right now, if depending upon credit's a major, the three indicators of interest rates. One would be your credit score. Okay. The second would be your down payment and loan to value are the two big indicators of that. And then the third one, sometimes it comes into play, which would factor into your mortgage insurance, would be your debt to income ratios. But with good credit, 20, 25% down, interest rates are somewhere at around 6.125, maybe a little bit better depending upon the circumstance if you get to that 25% down threshold. So we are coming in the right direction. Again, I think what's impacting us today, war is typically, unfortunately, is usually good for interest rates. The problem is we're at war right now with someone that controls oil. Oil is a major impact, that drives interest rates, or has a level that impacts interest rates. So as the oil price is going up, interest rates have gone up. So what's happening is, as we have into this ceasefire type operation, things have been slowed down, which in turn has brought down the oil, which is bringing interest rates back down some. So it could be short term, because if it just gets back into the same situation where we were, rates could potentially go up. But if we can settle something and get into this peace agreement, I think long-term projection is rates are going to trend in the right direction.
Yeah. Sure. How often do you reach out to a guy like Paul Scollage from rate.com? Are a lot of your buyers cash buyers? Do they sometimes need financing? What's the deal? What's the biggest down payment that you typically see when you reach out to Paul?
Well, Paul is my guy for my mortgages. I always send my clients to Paul because Paul looks at the whole picture. He understands second home buyers. He'll talk to them about other options, like sometimes taking a home equity line on their primary home, and then they could put more money down. But yeah, I mean, Paul, so sometimes we have where there's no mortgage contingency, meaning it's a cash deal, but people are actually getting a mortgage. They're just not making it a contingency. Because look, when Paul tells my person or my buyers that he can get it done, he can get it done. And I also would highly encourage people, please don't shop on the internet. Please don't do that. You need someone local that understands it's a second home. It's different. And again, if rate.com and Paul's team says they can do it, you will make it to closing. And that is the most important thing. And that's the thing the seller wants to know.
So wait, let me real quick. What does that mean? Can you make it to closing, Paul? What is that? Yeah. What's that risk you sometimes encounter?
Wait, let me just say what it means. You're shopping on the internet. You get this mortgage pre-qual, but it's not based on any good information. You go to everyone thinks you have that letter that means something. What means something is where that letter, that mortgage pre-qualification comes from. And Paul would actually do underwriting before he even gives that letter. He knows, that's what I mean. When he says he'll get it done, he'll get it done. He's looked at everything. It's not just you go online and you're shopping for rates. And Paul, now I'm going to turn it over to you.
Yeah. Yeah, a couple of things that we look at, and I talk to clients all the time. There's a pre-approval, there's a pre-qualification, and then there's what we call a commitment letter. So clients are intrigued to go online. They put in their information. They physically do not speak to anyone. So whatever they put in the system for income, it generates and spits out a pre-approval. Now they have this pre-approval in their hand. It could be somewhere at Rocket Mortgage or some online bank in Kansas. So now when they go talk to the realtor, I got pre-approved, here it is, right? So there's a great chance that that income could be wrong, that no one has physically spoken to the borrower. I take it an extra step where I will gather the borrower's income and assets, okay, W-2s, pay stubs, in some cases, tax returns, send it through my underwriting channel. Let my underwriter physically review it, sign off on it. Now, I'm going to then issue a commitment letter that their income and assets have been reviewed and approved through underwriting. So the only thing at that point that could prevent that borrower from getting from getting the house would be as if they lost their job. That would be the only thing that could ever come into play that would prevent them from buying. So people are so caught up on, hey, I went online, I saw an interest rate, it was way better than what Paul could offer. One of two things. One, what is your APR compared to your interest rate? There is a lot of times that lenders will put discount points on the actual closing cost estimate. So when you look at the rate, I could be at 6%, the online bank's at 5.5 or 5 5/8. Why is Paul higher? Well, I'm higher because I'm not charging them points. I'm not charging the client to pay on their own to lower their interest rate. In my opinion, in this market, you should not be paying discount points to buy down your rate. And the reason why, you're going to be in this loan 12, 14 months. You won't be in the loan long enough to recoup the cost to buy down that rate because you're going to refinance out of it. So take the higher rate, stick with it. Then we look to refinance at some point. And at that point, when you're refining, if you want to buy points, because this might be the lowest rate that you see if you're in the house for the next 30 years, at that time, take advantage of doing it. But yes, pre-qual, pre-approval, and commitment letter.
What do you think, Cher?
That's why Paul's my guy. That's why I send my clients to him, because I trust him. And then just on the flip side, if I'm representing a seller and they bring me an offer with the letter. So when you have an offer, you always have to have proof of funds, whether it's the mortgage letter or whether it's the cash, if you're paying cash, that you have the assets. But I would take the extra step and I actually call that mortgage person and ask them, the letter, sometimes these letters are just meaningless. Like Paul's saying, his letter takes it to an extra step before he issues that letter, the pre-qual letter. So as a selling agent, you also need to evaluate that the buyers that are being brought to you are truly qualified by someone who is like Paul and Paul's team and capable of really qualifying them and is not just putting a letter out there.
Yeah. So, Paul, just real quick answers. What's the definition of an underwriter for the average Joe? And is now a half decent time to consider the unmentionable adjustable rate mortgage? We've been taught be careful, but now might make sense to consider it. Am I wrong about that?
So adjustable rate mortgages are very common practice right now with what the current market is doing. And typically there's a spread between the 30-year fixed and the ARM. If the 30-year fixed and the ARM are pretty close together, in some regard, it doesn't make sense to go ahead and go into that ARM product when there's maybe 1/8% difference. But when you got a 0.5% gap in your 30-year fixed versus your adjustable rate mortgage, going into that ARM product right now is, in my opinion, is still a secure option, because there will be a great time for you to refinance out of this product in the next 12, 14, 18, even if it's 3 years. How the rate works and the ARMs work is you're at a 5-year fixed rate, amortized over 30 years. It'll never adjust in the first 5 years. However, you can refinance out of that rate at any given point and get yourself securitized into a 30-year fixed. Take the lower rate, take the ARM, short-term rate, get out of it once the rates come back down or come down. So yes, adjustable rate mortgages are very common right now.
Paul, can you tell everyone what your fees are when someone refinances with rate.com? Because I do believe you offer some advantages over some other mortgage companies for refinancing.
We do. So we will cover all of your lender portions. So basically your underwriting, your processing, and your appraisal, which is about $2,500 that you'll save. You're responsible to pay your title insurance, which you'll get at a reduced rate, and your credit report. Everything else is covered. So we give you an option to take advantage of coming back to us, and we'll discount certain things for you. And then title insurance, we have a reduced rate on title insurance, especially since you just bought. But yes, take advantage of getting into a lower rate. Like I mentioned, buy your house. If it's 1/8 higher or 1/4% higher than where you want to be, it's okay. Get into the house that you want, and you'll be able to refinance out of it.
How about the stock market? So everybody, while they were smartly leveraging their gains of their the stock portfolio, are they a little reticent to tap their portfolio now compared to maybe a year ago?
I mean, listen, anyone right now in this market that's going to buy a house and they want to go into their 401ks, there's definitely options to where you don't have to liquidate or take the money out. There's something that's called a margin loan where you can borrow against yourself, keep your money still invested, and pay an interest-only type of program back to yourself. So you're not getting your money out of the market. You're not taking it away. You're not paying taxes on it. You can keep it where it's at and utilize that for your down payment. So, the stock market right now is probably, it's at an all-time high. So I don't think people want to go ahead and tap into that when the market's good. If you have multiple properties, you can do a line of credit, take the line of credit out on your house, use that money as your down payment. Take the line of credit out on your primary residence if you want to buy a shore house. If your primary residence, there's no mortgage on it, you can do a cash out refinance on your primary to buy down the shore. You get a better interest rate on taking the money out of your primary residence than you do on a second home or investment. So utilize the equity that you have in your primary residence if it's something that you want to purchase down at the shore or even up the mountains.
And you're saying because their primary residence might be a concrete asset, something that is much more tangible as opposed to a highly fluctuating digital asset like a stock portfolio. Am I saying that the right way?
You are. So your fixed asset right now is your property. The fluctuation in the stock market up and down, and the validity probably doesn't want to set somebody up to start taking money out of there because, hey, listen, if it's up right now, the market's doing great, why would you want to liquidate and take anything out of there? Use your fixed asset, which is your primary residence or your second home or even an investment property if you have equity in them.
So your underwriter, he likes that you have a house in a great neighborhood on a great plot of land. but not so much your great, awesome 401k. He'd much rather go with the real estate asset.
Well, the good thing when you have retirement investments portfolio, underwriting likes to look at what's called reserves. So they like to see, once you close on the loan, your checking and savings account have X. But if you have a big nest egg in your retirement account, that money there can be utilized for reserves. You don't liquidate it. You don't touch it. Underwriting says, okay, if you lost your job, you have 30 months of the mortgage payment sitting into another account. That helps people qualify. You don't utilize the money for closing. It's just sitting in that account. And then we utilize that as reserve money.
Sherry and I were talking a lot about retail and a lot of commercial businesses that are, well, they're available in the Margate, VENTNOR area. We're hoping they get filled. How much different is it when somebody calls you to get some financing information? How are you different residential-wise, Paul, than maybe your colleagues that deal with commercial? What are the key differences between the services that Rate.com provide?
So, I mean, we do everything. We do residential, we do commercial, we do new construction. There's a lot of different avenues that we offer. We're licensed in every state, so we can physically do a loan for you just about in every state and different capacity. Me personally, I am only licensed to do residential loans. So I only like to do the loans that I can control, that I have full conversation with my underwriting department on. So if someone wants to do a construction, a perm loan, that we have to send it out to a broker, that's not my specialty. I don't have the relationship with the broker. I don't have the relationship with that underwriter. I don't know the ins and outs of how that company operates. So for me, my advantage and my ability to close every single loan that I put a pre-approval on is something on the residential side. So different animal on the commercial side of things. I stay in my lane. That's what I like to do.
Speaking of lanes, Sherry Lilienfeld, you may know her from eXp Realty. She's wondering, Paul, this Strait of Hormuz thing, should she be discussing that with you and maybe her clients? The Strait of Hormuz. Can you explain further, please?
Let's just open it up, Dan. Let's open everything up just so we can get some oil flow and the market to settle down. Once the market settles down, I mean, we had 4 weeks ago, we had a great run. Rates were trending into like the 5.5 direction. It was great. All of a sudden, bingo, the war hits and everything is taking back. It'll get settled down. Rates will come down. Hang in there. But again, if you want to buy a house, do not let that 6.5 or 6.25 interest rate bother you. They will come down.
Sherry Lilienfeld, the war in Iran and the Strait of Hormuz, that it seems to be the most influential, has the most influential impact on home buying. It seems like oil, let's admit it, oil and energy has the most impactful effect on real estate. Yes, no, accurate?
I think investors in general, because there's a lot of fluctuation. And look, we're in a second home market. The average sale price is over $2 million. So
that's it. Jesus.
Average or medium. Yeah, we still have homes that are 10 million, 12 million. But anyway, you know, our buyers are people that think a lot about this. Is discretionary money. This is second home. They don't have to have these homes to live. They're something that they want. They're wants, not needs. So they are very cautious with their money, and it does cause some pause. But the snowstorms we had caused some pause, and then, like Paul was saying, then things started getting better. And now we have this war and oil prices going up. So there's just a little bit of a pause, but there's still a lot of people with a lot of discretionary money, and they will start spending it again. So I do feel like it's just a slight pause.
Final words, Paul Scollage of Rate.com.
Rates have a major impact on your decision on buying a house. Don't let that extra 0.25% in that rate, maybe $100 or $200 extra a month, shy away from buying that house. We will see improvement in rates that'll put you in a better position. So buy the house that you want. Take advantage of it now.